Welcome back to All About Economics. In the last episode, we learned the golden rule of finance, that you must judge a return against the risk taken to earn it. But how do you actually do that with real numbers? Every investor faces the same problem. You have several funds in front of you, each with a different return and a different level of risk, and you need to pick the winner. Today, we meet the three famous tools the professionals use to do exactly that: the Sharpe Ratio, the Treynor Ratio, and Jensen's Alpha. We will see how they define risk differently, how they separate genuine skill from dumb luck, and why these very metrics quietly shape the investment advice you are given. Let us measure performance properly. Section 1. Why return alone fails. Imagine you must choose between four options: Fund A, Fund B, Fund C, and a plain market index fund, each with its own track record. The most intuitive move is to just pick the one with the highest return. And that is exactly the wrong place to stop. As we saw last time, a high return achieved by taking wild risks is not the same as a high return earned safely. Comparing funds by return alone is like ranking drivers only by their top speed, ignoring how many crashes they had along the way. To pick the true winner, we need a way to put return and risk together into a single, comparable score. That is precisely what performance ratios do. Section 2. The Sharpe Ratio. The most famous of these tools is the Sharpe Ratio. Its idea is beautifully simple. It measures the extra return an investment earned above the risk-free rate, the return you could get with no risk at all, and divides that by the investment's total risk, its volatility. In plain words, the Sharpe Ratio answers, how much reward did you get for each unit of risk you endured? A higher Sharpe Ratio is better because it means more return per unit of risk. Two funds might both have returned 10%, but the one that did it with lower volatility has the higher Sharpe Ratio and is the smarter investment. The Sharpe Ratio turned the vague idea of return per unit of risk into one clean, rankable number. William Sharpe won a Nobel Prize for this and related work, and decades later his ratio is still the single most quoted number on a fund fact sheet, often the very first thing a professional looks at when sizing up an investment. Section 3. Not all risk is equal, but the Sharpe Ratio makes one strong assumption worth questioning. It uses total risk, penalizing an investment for any and all volatility. Modern finance, however, splits risk into two very different kinds. The first is systematic risk, also called market risk, the risk that comes from the whole market moving, that no amount of diversification can remove. The second is unsystematic risk, the risk specific to one company or sector, which you can diversify away by holding many assets. Here is the key insight. If you are a well-diversified investor, you have already eliminated the unsystematic risk, so the only risk that should really concern you, and that the market rewards, is systematic risk. That distinction gives us a second, sharper metric. Section 4. The Treynor Ratio. Enter the Treynor Ratio. It looks almost identical to the Sharpe Ratio, the excess return above the risk-free rate, but it divides by a different measure of risk. Instead of total volatility, Treynor divides by beta, the measure of systematic risk, how much an investment moves with the overall market. A beta of 1 means it moves in line with the market. A beta of 2 means it swings twice as hard. So the Treynor Ratio answers a more refined question: how much reward did you get for each unit of market risk you took? For an investor who is already well diversified, this is often the more relevant measure, because it ignores the company-specific risk that diversification has already neutralized. Section 5. Sharpe versus Treynor. So which should you use, Sharpe or Treynor? The answer hinges entirely on that distinction about risk. The Sharpe Ratio, using total risk, is the right tool when an investment is your whole portfolio, or close to it, because then all of its volatility matters to you. The Treynor Ratio, using only systematic risk, is the right tool when the investment is just one piece of a larger, well-diversified portfolio, because there its company-specific risk has already been diversified away and only its market risk counts. They often agree, but when they disagree, it is telling you something important about how much of the fund's risk was the kind you could have diversified away for free. Section 6. Jensen's Alpha. Now the most fascinating metric of all, because it tries to answer the question every investor truly cares about. Is the fund manager actually skilled? or did they just get lucky? This is Jensen's alpha. The idea is to first calculate the return an investment should have earned, given the market risk, the beta, it took on. Finance has a model for this expected return, called the capital asset pricing model. Alpha is then the difference between what the fund actually returned and what it was expected to return for its level of risk. A positive alpha means the manager beat expectations, delivering returns beyond what their risk-taking alone would predict, the fingerprint of genuine skill. A zero or negative alpha means they did not really add value. Think of alpha as a manager's report card after grading on a curve for risk. Two managers can post the very same raw return, but the one who did it while taking far less market risk earns the higher alpha and is the one actually worth paying a fee for. Section 7. The 5.5% riddle. Let us make alpha concrete with a riddle. Suppose a fund returned 5.5% while the market returned only 2.5%. More than double the market. So it must be a brilliant fund. Case closed, right? Not so fast. What if that fund was extremely aggressive, with a high beta, so that given the risk it took, it should have returned, say, 7%. Then despite beating the market, it actually fell short of what its risk demanded. Its alpha is negative. It underperformed once you account for risk. Alpha exposes exactly this, the difference between a manager who is genuinely skilled and one who simply wrote a high-risk bet to a headline-grabbing number. It is the truest test of added value. Section 8. Why the metrics shape your advice. Here is the part that touches your own money directly. These metrics do not just sit in textbooks. They shape the advice you are given. Financial advisors and fund managers are themselves judged, hired, and paid based on these very numbers. That creates subtle, powerful incentives. A manager judged on short-term performance metrics may avoid bold but sensible long-term bets, sticking to whatever keeps their numbers looking safe and conventional. The result can be advice that follows the crowd, optimized to score well on the metrics rather than to do what is genuinely best for you. So understanding these tools is not just academic. It lets you see the invisible pressures behind the recommendations and ask the sharper question, good performance, measured how, and for whose benefit? Conclusion. We have turned return per unit of risk into real, usable tools. The Sharpe Ratio measures excess return per unit of total risk. The Treynor Ratio per unit of market risk for the diversified investor. And Jensen's alpha reveals whether a manager truly beat what their risk level should have delivered, separating skill from luck. We saw that a fund can double the market's return and still underperform once risk is accounted for. And we saw that because the whole industry is judged by these numbers, they quietly steer the advice you receive. Carry these 3 tools with you, because they are how professionals actually grade an investment. Next, we look at the vehicle most people use to invest, the mutual fund. If this sharpened how you judge performance, please subscribe to All About Economics and share it. See you there.